we'll give it a couple seconds for guests to join virtually. All right. So good morning and welcome to the Hawai'i Retirement Savings Board's December 15th board meeting. My name is Alani Kioki and I'm the Executive Director of the program. Before the meeting is called to order, the chairperson will explain the procedures to participate in this hybrid board meeting, including how members of the public can participate and interact with the board during the meeting.
For those of you with internet access, to view the meeting and provide live oral testimony, please use the link at the top of the agenda. You'll be asked to enter your name. The board requests that you enter your full name, but you may use a pseudonym or other identifier if you wish to remain anonymous. You will also be asked for an email address. You may fill in this field with any entry in an email format, for example, etc., mail.com. Your microphone will be automatically muted and video will be turned off. When the chairperson asks for public testimony, you may click the raise hand button found on your Zoom screen to indicate that you wish to testify about an agenda item. You will individually be enabled to unmute your microphone, turn on your video if you choose to, and testify. When recognized by the chairperson, please unmute your microphone and turn on your video if you choose to before speaking, and mute your microphone and turn off your video after you finish speaking. For those of you with phone access, if you cannot get internet access, you may get audio-only access by calling the Zoom phone number listed at the top of the agenda. Upon dialing the number, you'll be prompted to enter the meeting ID, which is also listed at the top of the agenda. After entering the meeting ID, you'll be asked to wait until you're admitted into the meeting. When the chairperson asks for public testimony, you may indicate you want to testify by entering star and then 9 on your phone's keypad. After entering star and then 9, a voice prompt will let you know that the host of the meeting has been notified. When recognized by the chairperson, you may unmute yourself by pressing star and 6 on your phone. A voice prompt will let you know that you are unmuted. Once you are finished speaking, please enter star and then 6 again to mute yourself. For both internet and phone access, when testifying, you'll be asked to identify yourself and the organization, if any, that you represent. Each testifier will be limited to 5 minutes of testimony per agenda item. The chairperson of the board has the discretion to provide a member of the public more or less time according to the agenda item and the number of persons assigned up to testify on the agenda item. Pursuant to Hawai'i Revised Statute, Section 92-3.7E, the board may remove or block any person who willfully disrupts or compromises the conduct of the meeting. Connection to the meeting is lost for more than 30 minutes. The meeting will be continued on a specified date and time. This information will be provided on the board's website at labor.hawaii.gov. Also, instructions to attend State of Hawaii virtual board meetings may also be found online at labor.hawaii.gov. Conduct a roll call of the members, starting with myself. I am present. Derek Shigano, Budget and Finance Director's Delegate.
Present and alone.
Thank you, Derek. Keola Dean.
Present and alone.
Thank you. Barbara Creed.
Present and alone.
Thank you. Andrew Nomura.
Present.
Brian Taniguchi.
Present.
Representative Jackson Sayama.
Present and alone.
Thank you. Now call the meeting to order at 10:04 a.m.
Chair, if I may,
Sure.
For just housekeeping purposes, for the members attending virtually, you must keep your cameras on at all times during the open session. Thank you.
Okay, we'll go on to our agenda item number 2, which is approval of the minutes. The October 28, 2025 open session meeting minutes. Are there any members from the public wishing to provide testimony at this time?
See none.
I've also seen none. Any of the board members have any amendments to any of the minutes? Not see any. If I may take this vote on unanimous consent, do I have consent?
Yes.
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 Approved. Our next agenda item is implementation of the Hawai'i Retirement Savings Program. The Hawai'i Retirement Savings Board will evaluate 2 multi-state partnership proposals for implementing the Hawai'i Retirement Savings Program with a focus on cost, governance, scalability, and operational readiness. The 2 proposals to be considered and decided on are the Partnership for a Dignified Retirement, or PDR Colorado led, and the Retirement Alliance Connecticut led. At this time, are there any members from the public who would like to provide testimony on this agenda item?
There are none.
I do not see any. So members, you had an opportunity to review the information providing in your board packet. Is there any discussion on these proposals?
I had a question. On the asset-based fees, you know what's the present level of assets under management offered? I got 213 million out of the Colorado program.
I couldn't find it under for Connecticut, but Addison, are you? Oh, Jessica's here. Jessica, can you please admit Jessica? Hi, Jessica. Are you able to unmute yourself and turn on your camera?
Hi there. It's Jessica Muirhead from the state of Connecticut. I don't have, it says I don't have the ability to start my video.
That's okay. We'll work on that, but I'm not sure if you heard Mr. Nomura's question.
I did not. I apologize.
What's the present assets under management?
The present assets under management in the state of Connecticut?
For the Retirement Alliance.
For the Retirement Alliance, it is a little over 55 million. We're just starting to get assets in from Rhode Island this month as they are getting up and started.
And so what do you expect it to be next year?
So with the current growth of the Connecticut program, we would expect that to, plus adding in Rhode Island, we have predictions of hitting 70 million next year.
What about number of accounts? Where are you at? Number of accounts this year versus next year?
I would, let me look up our prediction on our chart. Let me just, 1 second, 1 moment. So,
75,000.
sorry, could you repeat that?
Was it around 75,000? Plus 40 additional from Rhode Island? 40,000 additional.
So we're looking at probably adding somewhere between 10 to 20,000 in Connecticut this coming summer alone, just because of the we're adding in a number of PCAs from the state into the program. So that's 20,000 in July of 2026. That will be an injection at that point. And then we would probably see another 10,000 of natural growth under the Connecticut program with the implementation of compliance moving forward into next year. That is a rough estimate. We don't have a great way of predicting exactly how many would result from those compliance efforts, but that is our sort of, conservative estimate of additional from that. And then in Rhode Island, we would expect to see the growth similar to the growth of Maine, just, comparing the size of, Maine and Rhode Island, as well as, potentially Vermont, a similar amount to their first year of growth. Just, comparing the size of those states, that's what we would expect to see within the next year from Rhode Island as well.
So what would it be in total? I'm just trying to compare that to 350,000, which is the next threshold for your accountants fees.
Sure. So it's unlikely we would hit the 350,000 between the two current states of the partnership within the next year or so. That's I think a tall order just between the two current states of the program. Our next drop point before that is the 75,000, and I would expect to hit that within the next 2 years with Connecticut and Rhode Island alone.
Thank you, Jessica. I see, Barbara, you have a question?
Yeah, I do. Jessica, if you don't mind, could you speak to the decision to do a contract for custom portfolios by BNY Mellon, pros and cons, and what happens if those investment options are not hitting benchmarks?
Sure. So we went with a custom portfolio for a couple of reasons. When it was originally designed way back in 2020, 2021, we had wanted to keep the underlying investment fees as low as possible. So, an off-the-shelf product, we have less control over. They're not designed specifically for the type of demographics in these programs that are affected. So generally lower income folks. And what the board at the time was trying to do was to reduce cost and risk to the, sort of assumed typical demographic of a participant in this program. That was sort of the design element that we looked at when this was originally created. So that's what we've been working with. It also allows the program to have a little bit more oversight and control over that performance. So, to speak to your comment about performance and meeting benchmarks, we have that double checked by a second investment consultant, Siegel Marco, as well as overseen as within Vestwell with Vestwell Advisors and the subcontractor, the Bank of New York Mellon, who designed those portfolios. And if we feel that they are underperforming, there is a yearly review process that we're actually about to go into in Q1 and early Q2 of this year, wherein they will look at the performance of the chosen underlying investments, and then we'll make a recommendation through a process there to either swap out funds for ones that they think are either performing better or are performing equally well, but maybe cheaper. So, for example, last year, one of the things we did was one of the underlying funds was swapped out for one that was slightly cheaper. It just cost less basis points, but its benchmarks were just as good as the one that we were using. And then a few others were consolidated. And then this year, one of the things that we're going to be looking at is the potentially looking at the glide path and making sure that the glide paths are appropriate to the program to potentially improve returns earlier in the investment process over later in the investment process. And that is all double checked by our investment consultant here in Connecticut, and then will be run through a process with the partnership for recommendation for for implementation before that is finalized and implemented into the program, if in fact we do move forward with the changes as recommended by the investment advisor.
Thank you. Alani, I'm not sure who would answer my next question, which is how is that different from what we see in the Colorado consortium? It
So
seems that
Hunter-
both have flexibility, but obviously both are monitoring performance, but how is that different?
So we're going to admit Hunter Rayleigh, the executive director of the Colorado program. So you're going to have to make him a co-host.
And then Jessica, your camera should be able to work now.
Okay, let me see if I can sign in on a different device and it will allow me to start my video. So one moment, I'll just switch to a second device.
Hunter, are you able to unmute and turn on your camera? There we go.
Did that work?
Yep.
Perfect.
Barbara, would you like to ask your question again?
All right, thank you. So Hunter, it looks like one of the potentially meaningful differences between the two programs we're looking at is that the Retirement Alliance has a what they call a custom portfolio by BNY Mellon, and the investment options identified by your consortium alliance don't have that same descriptor. What is the difference?
So for us, the rationale of not using custom is that these products, generally speaking, when you're using an off-the-shelf retirement product, so the target dates are a good example where it's a standard default, is they are designed for the broadest potential population imaginable. Our rationale was we don't actually know who these savers are. So we don't know their income, we don't know their occupations, we don't know their savings goals, we don't know really anything that would give us any real insight into what should be offered by way of customization. So that is helpful on the one hand, and then I would say on the other hand too, in the context of a partnership, using a off-the-shelf product with standardized benchmarks that are uniform and really uncontroversial allows us to it allows for independent board oversight for our partner states in an environment where we're not where there's not going to be any controversy over whether the investments are performing to benchmark. So that is to say, like if Hawaii in this hypothetical situation is looking at State Street target date 2070, and Colorado is looking at that, we are going to be looking at the same shared benchmark, and our consultants and our internal staff are going to say yes, it's performing to benchmark, or no, it is not performing to benchmark. So those were the primary reasons for it. And really the core design was to scale as quickly or scale beyond the initial state of Colorado, but also to do so in a way that provided the most plain vanilla middle of the road product to kind of stay out of areas where there would be discrepancies or differing versions or interpretations or analysis as we manage the investments.
All right, thank you.
Do any other members have any questions or thoughts? If not, I note that the executive director put together a one-pager summing up some points for the board to consider when looking at and making a recommendation for either of these. So I could hand it over to the executive director.
Before I get to this summary, I do have a question for Jessica and Hunter. So in review of the documents that you submitted, there is a startup fee for the Retirement Alliance of $100,000 paid by the partnering program. Hunter, the contracts that you sent over were silent, but that is negotiable. What is, or what are some of the other fees paid by the other partnering states for the PDR? If you can share those.
So there are no additional fees beyond the startup fee, and my understanding is that and I can't speak for Jess, but it's going to be standard. I think they're identical for Connecticut and Colorado. But Jess, I don't know if you have information that I don't.
No, I do not actually. And that's true. So whatever Vestwell would charge would be charged equally in whatever partnership. That's been their standard response for that. So regardless of the what the fee is, it would be applicable in both of the partnerships. And as to what the fees have been, they have been fairly uniform, I think, with some changes depending on some very specific circumstances related to the laws of individual states.
Great, thank you.
So going back to that, Jessica, you said use the word applicable, but is it going to be equivalent to what other people have paid?
That I don't think I can speak to because I think that Vestwell would need to work that out directly with the state in terms of what the the plan for implementation. So I think probably a conversation with Vestwell would be warranted in that case too, because they didn't provide anything specific to us about that.
Okay, so it wouldn't. So what it means is that wouldn't be any different between the Colorado program and.
Yes, whatever that fee would be is that it wouldn't be any different between what would be applied with the Connecticut partnership versus the Colorado partnership. Whatever it is, it would be the same in each partnership. So, but what that would be, Vestwell did not specify at this time, I think before a conversation with Hawai'i directly.
Okay, I see, Barbara, you have a.
Yeah, I have another question, and I'm not sure who is best to answer it. Perhaps our deputy AG, and I can't see who's there today. There are differences in terms of how each of the partnerships is describing the fiduciary, the relative fiduciary duties, responsibilities. Connecticut is using the term fiduciary for its own role. Colorado is not. And I don't know, I can't comprehend or picture how that makes a difference in terms of how much autonomy Hawai'i would or would not have, and also how much potential liability Hawai'i would or would not have to its own, members or, its own savers. How does that work?
Well, I think the liability of the board has been out of discussion.
Sorry, can you either speak a little louder or maybe move the volume up? That's hard to hear.
Audio settings. Maybe you need to come closer. Sorry.
Is this better?
Yes, thank you.
So I think the issue of board liability has been discussed in an earlier meeting with another deputy attorney general. I'm not sure I understand your question in that I don't see how Colorado's fiduciary duty would increase or decrease the liability of the state board. Maybe I'm missing something.
My question comes from the way the respective states are describing the relationship. So maybe Jessica, what does it mean to say that Connecticut is the sole fiduciary, or Connecticut? What is Connecticut's responsibility or not vis-a-vis the decisions that the partnership makes and the the assets or whatever of Hawaii residents, and then and then Hunter would be. I think Colorado has made a point of saying we're not a fiduciary except with respect to our own participants. And again, trying to get a feel for how that may be different in terms of both partnerships.
Sure. So I think I'd have to review what I wrote, and maybe I didn't write it clearly enough, but we actually take the same position that Hawaii is and each partner state is a fiduciary, retains fiduciary responsibility to its own participants. I did write in there that Connecticut is a sole fiduciary state in the sense that our fiduciary is not a controlling board. It is the comptroller himself is the fiduciary and trustee for Connecticut residents. So maybe that's where the confusion lies. But in terms of the way that works within partnership, it's the same. We consider that each state is a fiduciary to its own participants, and Connecticut is not a fiduciary to, Hawaii's residents or Rhode Island's residents.
Right, so it's not as if Connecticut then has a super power,
No.
Over what happens within the partnership and
No.
Okay, all right, thank you. So Hunter, I think that's exactly what you described the Colorado role to be. So there would be the same.
Yeah, it's really to state that the fiduciary obligations for the state of Colorado stop at the four corners of Colorado. So really what you are looking for and it's again the same for Connecticut is entering a structure with the idea that you as a board are going to make your own decisions, work with whoever the executive director is in the context of whatever our joint governance arrangement is, and really at the end of the day, be tracking your own fund performance, your own enrollment performance, tracking communications and the like.
Okay, thank you.
Okay. Alani?
And I provided an executive summary of the two partnerships for your consideration. So you have the PDR, the Colorado-led program, and the Retirement Alliance, the Connecticut-led program. If you are considering the PDR partnership, this partnership offers Hawaii a cost-effective, collaborative, and scalable solution aligned with the state's goals. If you're considering the Retirement Alliance, this option is suitable for states, including Hawaii, seeking simplified administration and customized investment design. No.
I have a question. So with either of these, how would the state staff interact with the other partners and the alliances? Would it be mostly virtual or through electronic communications?
So based on what I've read, virtual participation is provided. There are a panel vote for Connecticut, and similarly, there's like a council of Colorado. So please correct me if I'm wrong, Jessica and Hunter, but I can participate in all of these meetings virtually and or by phone.
Yes, that's correct.
That's correct.
Okay.
I have
and
a
see
question.
Ebola, you have a question?
So in the description of the governance in Alani in the staff analysis for Colorado, it says one state, one vote, but for Connecticut, it says collaboration model. How does the Retirement Alliance handle voting on key decisions within the collaboration model?
Sorry, did you want me to speak to that or would you? Okay. So that's it's similar that we wrote in in our response, our RFI response, that each state receives one vote per decision that's, appropriate to panel discussion.
Okay, thank you, Jessica. That's what I thought.
Sure.
I have another question. Was there any analysis of the investment fees and the program administration fees between the two proposals? Because they really they vary a little bit. You have the asset-based and account-based fees, which I see that the PDR is generally lower by a hair. But when I try to compare the investment fees, the Retirement Alliance appears to be lower. And so I'm wondering if there's been any analysis of that um, on DLNR side.
Labor side.
Yeah.
So if you look at the PowerPoint presentation that I provided in your packet, I did go over some of the cost structure.
Yeah, those are on the asset and account-based fees and the revenue fees. Oh, wait, cost structure below.
So the state revenue fees, startup costs, and again, Hunter corrected me. I thought it was negotiable. It was a negotiable fee for the startup costs, but it sounds like it's a similar fee across the board per partner state.
Yeah, the startup fee is a function of the record keeper and not Colorado. So that fee doesn't come to Connecticut or to Colorado as states. And I think I won't speak for Jess, but I think both of us have limitations on incurring costs within our governance structure that like you basically, unless we decide there's a joint contract or for marketing or something like that, there's no money from Hawaii comes to Colorado.
Similarly, Connecticut.
Yeah, my
Yes,
question is
that's correct.
sorry, my question is different. My question is with regard to the investment fees and the program administration fees. Those are not in your PowerPoint, Alani. And so that's my question. How are those set? And does PDR and retirement negotiate those with the I don't know who they are, the investors? I'm not sure of the terminology.
Yeah, Barbara has her hand up. I apologize. No, KLI did not include that in my assessment. Yeah.
Can you Gil, I think you're talking about this. There's this one chart on investment management, and the Retirement Alliance points out ultra low fees at 0.035%. What's the equivalent for Colorado?
Yes, and how are they set? Exactly.
What are Class K shares? What's the fee for Class K shares?
So for Class K shares, there is It'll depend, and I think it's true of the alliance too. It depends what you're investing in. So the target date is the standard default option. They are 9 basis points right now, but then as we scale, they go down to 6 basis points at I believe 500 million in total assets across the structure.
That satisfy your question, Kayla?
And then, I think to the point of who's negotiating, I apologize, sir, for so with off-the-shelf products, off-the-shelf is there's a standard fee. So that is, we're getting what institutional investors, your standard large corporate plan would get if they went to State Street or BlackRock and said, this is the fund mix that we would like for our retirement products.
Yeah, so it just seems like a big difference between a 0.09% versus a 0.03% that I see for the Connecticut product. So I'm worried that we're not comparing apples and apples if we're only looking at asset-based and account-based fees.
Okay, thank you. Barbara, you had a question?
No, I think so. We need to Hunter and Jessica. So we're trying to compare these investment management fees. So is the 9 basis points comparable to the 3.5 basis points? Are we comparing apples to apples there, or is
Those are apples to apples. I think it's just the mix of the dollar-based fee. There's some different distinctions on the dollar-based fees and elsewhere, and I think just please tell me if I'm off base here, but I mean, largely it kind of comes into what are terms of contract, namely how long is it, and then so over time as we grow and we see a drop in our asset-based fees for our target dates as we scale, that'll be beneficial, but dollar-based fees tend to impact savers earlier, but then the benefit of the hybrid structure, which we're both using, is the flat dollar-based fees sort of is cheaper over the long term as the programs scale and grow. So it's not apples to the asset-based fees aren't apples to apples, but it's kind of where Connecticut and Colorado are different is we're cheaper in different parts of our programs. And they'll impact us differently at different points in the evolution.
Yeah, I would concur with that effectively the Retirement Alliance's underlying management fund fees are lower, and then some of the the program manager fees are slightly higher in certain places that and it's a sort of, I think Hunter's got it right on the nail on the head. It kind of depends on, the timeline that you're looking at, the length of the contracts, and also, the impact of those fees in the short term versus the long term. So I think it's probably a more complex analysis than just a direct one-to-one comparison. But in the Retirement Alliance, we have some slightly higher fees on the dollar-based fee in particular. In the short term, that'll drop at the 75,000 accounts. But then some of the other asset-based fees in the longer term are currently lower. So it's really kind of depends on the analysis of what Hawaii is looking for.
Okay. No other discussion about that particular item then? Okay, Barbara.
So I just want to be absolutely sure that both partnerships would have the capability for any of the savers, the participants, to opt out at any time with appropriate notice, and/or to change the percentage of contribution at any time, also with appropriate notice, right? Just to make sure I'm not missing anything.
Yes, that's correct.
Okay.
Yeah, that's a function of the platform. So Bestwell has a good system for that.
All right, thank you.
Any other discussion, questions?
Was there any difference in responsiveness from either party? Those what people get information and just give us a flavor for the relationship.
So both parties were very responsive. I had a clear deadline of December 1st to respond to the RFI. Both responded timely. Both were open to any questions I had regarding the appendix as well as the response. So I have to say both of them throughout my entire year with this program have been very responsive to all of my inquiries and quite frankly walking me through every single step of this process. This is a new program in the state. They have the experience and they willingly walk me through every single process. And there's like 5 and 6 hour time differences too. They worked with my schedule.
See, Keola, you'd like to speak?
Yes, this is a question these things for our Connecticut representative. The fact that these are custom products and not off-the-shelf products, did that play a role in your lower investment fees? Or is it all, are you taking your investment fees, essentially off the shelf the way that Colorado is?
So yes, that the custom design of the portfolios is the reason why those underlying investment management fees are lower than average in most other states. It's because of the custom design.
Sorry, I have a follow-up question then. So what aspect, are you able to articulate what aspect of that custom design led to the lower investment fees and program administration fees?
So I think part of it is that the cost of the advisor is included with, so, when you buy an off-the-shelf product, you're paying not just for the underlying investment manager fees, but also the people who created that portfolio, those target date funds. So that price is wrapped into Connecticut's, master agreement fees with the program manager, with the service provider. Those investment advisor fees for the folks who created those portfolios is wrapped into those fees rather than as a part of an off-the-shelf products fees. So that's where the difference lies. And one of the reasons why the fees are slightly higher, in some areas in the master agreement in the Connecticut partnership.
Thank you, Jessica. That now makes sense to me. Thank you.
Of course.
So in general, are the whatever the standard, your standard target date fees in the case of Connecticut versus Colorado, are the Connecticut programs investment model more conservative, therefore more sort of bond and cash heavy versus more equity? I mean, could that explain the difference in the fee structure?
I'll let Jess chime in a little bit. It's hard to compare, and I think probably the best trade-off is to think of is really where you get to Jess's point. There's some efficiencies in the structure, but there's also sort of like the introduction of a little bit of risk and really what Jess and this is not to speak against my CT savings. It was really design considerations of, how are we going to construct these things and where do we need to provide more oversight versus where do we need to be more conservative in our thinking? And in our case, we pay a little bit more, understanding that while assets are low, a higher basis point doesn't really impact savings so much, with the understanding that we could go more general with a financial product that is, broadly speaking, an industry standard for defaults. But and again, not to say it against, but Connecticut made different design choices and went for a more tailored product, and that's how they got the custom one. So it's really at this point, you're kind of looking at some nuanced distinctions of how we were thinking about the design process in the initial phases of program development.
Further discussion?
Oh, Barbara's hand is raised.
Barbara?
Yeah, sorry, I do have one more sort of a related follow-up question. Jessica, does the fact that you have the custom portfolio mean that the partnership must necessarily remain, contracted to BNY Mellon? Like, suppose for whatever reason that relationship fell apart. What happens with the fact that you have this custom portfolio, or does it? From what I recall, they were like Vanguard, aren't they the ones that are like Vanguard funds sort of thing? So it's not as if it's a BNY Mellon product,
Yes.
but are you necessarily tied into BNY Mellon because of that?
No, not necessarily. So the Bank of New York Mellon advisors are a subcontractor of the Vestwell advisors in the master agreement. So we are required to be given advising services, whether that subcontractor continues to be Bank of New York Mellon, who we have a great relationship with right now. But if they, for whatever reason, we're not interested in renewing or something like that, we are, required to have investment advising services. So those portfolios would be taken over by a second advisor, either a subcontractor or Vessel advising themselves. Subject to, Connecticut's approval of a replacement subcontractor and whatnot. And of course, that would go through the partnership process wherein, the partnership would be informed and then, the new advisor would be approved for taking over those portfolios. But the contract in general, to your point, if that relationship did fall apart, then the advising would be taken over by another advisor who would steward the portfolios into the future.
All right, thank you.
Paola?
Yes, thank you. Are there any expectations of the partnership states from either of your organizations or alliances that with regard to state regulations, administrative regulations?
You add some clarity to that is there consideration for variances and potential regulations on the back end?
Yeah, or are there sort of the flip of that? Are there any requirements for Hawaii to participate in terms of what types of regulations we would need to implement?
So it'll depend on what, frankly, what your standard process is for administrative rules. But generally speaking, the shtick for not just PDR, but any partnership is that they need to be operationally similar because that is where we get the economies of scale. So there is some degree of flexibility for differences in Hawaii and how you might make or write rules, but at the end of the day, it kind of needs to be a circumstance where savers are automatically enrolled, they have an opt out within a time frame, and that certain other core components that are embedded in the record keeping system work in a functionally similar way.
Jessica, would you like to add anything to that?
I concur really with Hunter that basically the requirements for partnership are laid out in the interstate partnership agreement. So if regulations are necessary, so if, the state statute is a little light and you need to create some regulations to sort of flesh out some of that, the regulations would need to fit the requirements to join partnership, but otherwise, the partner states are not subject to, Connecticut state regulations or statute or what have you. It's just that the law would need to match what's required of partnership, which are fairly, basic, that we probably wouldn't have replied to the RFI if, the state didn't already have those requirements in place.
Thank you.
Further discussion? Okay, so anybody like to make a motion in regards to our agenda item of which partnership to join?
You are seeking legal advice from your Deputy Attorney General. What we have to do is create a breakout room.
I just asked.
Would we like to go to executive session?
What are the legal issues?
Sorry, but once again, it's very hard to hear what's being said.
So we're discussing the potential of going into executive session and whether or not there are any legal issues involved. Member Taniguchi raised it.
I say that would be my preference if we can do that procedurally.
To discuss a legal issue, legal matter.
That's what I'm trying to figure out. No.
Macy.
I think it's just being able to speak freely without Jessica.
Well,
We can, but it's kind of.
It's awkward. Although, I mean, personally, it's hard. We have two really excellent options, and it's hard to distinguish what would be best for Hawaii, especially, we get economies of scale, and the Colorado-led partnership is obviously bigger at this point, and so we have what appears to be, perhaps a slight difference in fees, and yet, we're a smaller state, and I'm feeling sort of the alignment to the smaller at the moment partnership in smaller states, and I don't know. I'm not certain how personally to weigh which of the two excellent options would be better for us, frankly.
yeah, I think if it will make the board more likely to discuss the next steps, I mean, you could ask the representatives if they wouldn't mind just excusing themselves for the board discussion.
Yeah, we can place Jessica and Hunter in a breakout room.
Yeah, I was gonna say we can just quit and rejoin and sit in the waiting room.
Okay, we can just
We'll put them in a breakout room because
If that's all right with you folks, we can put you in a breakout room, and that way it might facilitate bringing you back in if there's any further discussions, as opposed to having to
Of course.
leave and come.
Sure.
thank you.
Thank you.
Okay,
So we should need them to join.
So you should, there you go.
Okay, so members, further discussion.
Maybe Gary, if you can sit up here in case they.
So right now
If I may make an observation and following what Barbara said, we'll basically have one vote out of a potential 3 versus one vote out of 7 there's something to be said for that. For now, yeah.
I mean, does
But that could
anybody
always
have,
change.
yeah, does anybody have any really strong feelings either way? You know, I mean, like I said, we've got good, you know, great options. So I personally am sort of like leaning toward the Connecticut led, but I'm not sure that I've got really good objective reasons for that, other than it seems like that would be a good fit for us, you know, especially knowing I want to be doing my fiduciary duty, and I can't really tell how meaningfully different the overall cost is when you compare the two partnerships. So thank you, Keola, for raising, you know, those other issues as well.
I think the difference is the scale, not scalability, but just the general size. We're going to get to break points faster with Colorado. So that's my vote is go big or bigger.
You know,
And I don't think the governance thing. I don't see the difference.
can I make a comment? I was looking through the materials and I didn't see any performance benchmarks of the mutual funds in the Colorado program, but I did see that Connecticut provided those. Is that correct?
That's right.
Do you guys want to see at least how Colorado's funds are performing at this point?
I don't think it matters. You know, the benchmarks are going to be similar, and if they're not performing, they're going to do something. So I don't think it's performance that they're looking at. I don't think investment performance is something that is a differentiator. It's going to be pretty close. It's going to be close. Yeah.
It's like
I agree. Oh, go ahead.
Yeah, for me, I guess I like both of them, and actually, if other people on the board were strong, you know, I'm fine with either one of them. I think I was leaning more toward Colorado because of the size and the kind of relative proximity. Just although we're doing stuff online, it doesn't matter. Just time difference and distance and all that stuff. But like I said, I'm not. It's just a slight tilt. It's not. Yeah. I think go ahead.
I guess I have a question to the executive director, because in the summary of each, you had mentioned that Connecticut Alliance perhaps we would have simplified administration, and considering that if you're fully staffed, I think we're a relatively small operation. So what made you make that assessment? I guess
It's really the way they established their panel. There's only one other partnering state, Rhode Island, and the fiduciary responsibility is through the comptroller. So that's what makes the administration part of it much simpler. So we can have input, but ultimately the decision is through the comptroller of Connecticut.
Well, why did you not make the recommendation?
Because it's your decision.
No. All we're asking for is a recommendation.
So I mean, similarly,
but you made a decision not to make the recommendation. Why is that?
Because I really want the board to make an informed decision. You guys are the experts. You understand the fees. You understand scalability. I am here to implement the program on your behalf. So that is why I decided not to make the recommendation. Because ultimately, legally, you are the only ones authorized to make this decision.
Can I just say I agree with Alani? I assume you can hear me now with the. Okay. And that is, first of all, I agree, Alani, it is a board's decision rather than yours. If there is something about either program that you have concerns about, I assume you would have raised that to us. But if not, we are in the, actually enviable position of having two really great options.
I have a procedural question. Are we in executive session?
No.
do we have members of the public? I'm seeing what looks like the waiting room. Do we have members of the public participating right now in this part of the
So
meeting?
they are listening into the meeting. They've not been admitted to add to the discussion now. Based on a review of the statutes, there are no reasons, unless you're seeking legal advice, for the board to enter into executive session.
Yeah, no,
So
I'm not asking to go into an executive session. I just wanted to make sure we're not in one.
We are not.
Okay. I agree that we have two great options. My concern is about the difference because initially I was in favor of the Colorado option because we're going to achieve economies of scale faster with respect to the asset-based and account-based fees. But my concern now is that the investment fees look on the Colorado product looks better. And so then how do we compare those two different options so that we can make an informed decision on the overall cost, not just the asset-based and account-based cost? You know, I just recently went through this with one of my organizations, and I ran I think it was like a $1,000 or $10,000 investment model and just tried to price out the different fees based on a dollar amount. And so I'm just so that I could get a range of what the different impacts were for the different 401k advisors. And then that led to an outcome that helped me decide or helped my board decide. So I'm trying to I think we need something like that because I don't feel like I have enough information right now to decide which one is cheaper.
Keola, in that analysis that you just referenced for the other organization, if we were to do something similar here, how many of the investment options would you feel comfortable having run through that analysis? Like if we were to request from each program to do that, give us, show us what the fees would be for, all of them?
I would run it through a typical mix. So they already have information on, what's the mix of investment vehicles. So then just on a percentage basis, what are the different investment fees, program administration fees?
I mean, because they said the target date fund is the default. I mean, would it be sufficient to just run that default, do you think? For different amounts of contributions or different amounts in the account?
If that default is really operating as a default, as opposed to their own members, investors opting out of that
Right.
default into something like a Vanguard, like a low fee
Right.
structure.
Because I have to tell you, I personally would feel much more comfortable if we had that sort of analysis, because I don't see any meaningful difference that I can objectively state in terms of the other factors, the other parts of the program.
So
Yeah,
it
I
was
agree.
hard for me to pull that out of the 400 pages. We received copies of standard agreements. So I will work closely with the executive directors to do that analysis. Unless people feel differently and want to vote.
So that's the consensus of the board, is to try to obtain more financial or cost and benefit analysis from both programs. Perhaps we can do that, and then at a subsequent meeting, we could have more information to make perhaps a more informed choice. Is everybody comfortable with that, or do we vote? Is there further discussion?
No, I think that's good. That's a good path.
I'm sorry, what did you just say, Andy?
That's a good path. to have a side-by-side, comparison of a typical account, what the fees would be.
Yeah, and if they're similar, then that takes that consideration off the list, and then we can make decisions on whether we want to be a bigger fish in a smaller pond or other considerations.
So just for me, my edification, Michaela, like, so when you're talking about like running scenarios, somebody who invests 1,000 or 10,000 over a period of a year, 5, 10, that kind of thing.
Yeah, and they should really be similar products. So, if the typical account is invested in a target fund, and then they should be at the same level so that we can compare all the fees, comparing apples to apples.
And this is for the member.
Yes, but then also taking into account the asset-based and account-based fees too. Because there are 2 levels of fees, right? And we need to make sure what the total cost is.
You want a description of all fees that are assessed to the accounts, the savers accounts. Because I thought I just heard you talking about the investment fee.
The investment fees, the program administration fees, which are assessed at the individual account level, is my understanding. We need to still make sure that those are low. That is our fiduciary obligation.
And as I understand it, we also have the issue of what additional fee, if any, we as a state would choose to charge the participants in terms of fees for our administration, right?
Yeah.
So Connecticut and Rhode Island charge a $2 fee.
Right.
And then one allows us to, in the materials, one allowed us to add on a fee. Probably both of them would at the end of the day.
Right.
So just to be clear, or to help make my what I'm trying to say clearer, it sounds like the Connecticut model shifted some of the cost away from the individual account holders and onto the asset-based and account-based fees. They accepted higher fees to then reduce the investment fees and the program administration fees for the individual account holders. If that results in a total reduction in cost for the program, to me, that's a good choice. But I can't tell without running through some of these simulations.
Great point.
So I think what you need to do is you need to ask them for sort of a typical account size, and what would it be at, this typical is probably 2 or 3 years down the line. So what would it be in year 1, in year 2, year 3, sort of a nominal growth. So you're looking at, for a very low account balance, probably the Colorado fee is going to be cheaper. At a higher number, Connecticut's, because of that difference in the investment management fee, that I think is going to start to drop. I mean, that's the way I would think it would come out.
But we'd want the 2 programs to use the same, not to say each choose a typical. I think we need to say to them, whatever is the typical, we need to run the same, have them use the same assumptions in terms of dollars invested and in terms of type of investment.
Right. So let's say a typical participant is 45-year-old. So, say it's 45-year-old is going to have one target date platform. Take that 45-year-old and compare that to both sides.
Right. In investing, $50 a month or $100 a month or whatever,
Right.
whatever it would be.
I mean, so you do it over a year. So, if they put in $50, say $600 a year, what happens? What happens at $1,000, at $5,000, that kind of stuff.
For what it's worth, based on my experience on the deferred compensation plan, the island savings plan, what happened is because you have the per account per month fee, that unless the participant was willing to invest a certain threshold amount, they would be told, or, it doesn't make sense for you to be in this program because the fee that you're paying is going to outweigh the benefit for you. So I think we have to assume that there's going to be some of that going on, that unless somebody is willing to invest whatever it may be, is it $50 a month? Is it $100? I don't know. So I'm thinking that we are not going to have the super, super small amount per paycheck deductions being made or contributions being made. I'm not sure how that would play into whatever the assumptions are on whatever parameters we set for the two programs in terms of this analysis.
Further discussion? Okay, so, you understand the
I do.
assignment?
I do, and I will work with Colorado and Connecticut. I will listen to the recording again to make sure my written notes match what you guys said as well.
Do you want to back it up?
Yeah.
Well, actually, move that. Unless it's closed.
Close all rooms, you're gonna close.
They'll return to the next session.
Okay, so thank you for allowing us some time to have a discussion amongst ourselves. And there was not a motion proffered to vote to make a choice at this time. However, the board is requesting some further information in regards to what's some of the actual costs and the impact to the individual investor as well as the program. So Executive Director Kioke is going to reach out to both of you and ask for some information and to ask you to run some scenarios so we get a better idea of the cost and exactly I think what the board is choosing. This is a very important choice, and I think the board wants to have as much information as possible in order to make this choice. I don't know, does anybody else want to add anything? No? Okay.
I just want to say thank you for both of your presentations and your materials. If you hadn't both created such good programs, this would be an easy choice for us.
Thank you, and thank you for understanding. This is quite a momentous decision for the state, and I think we just want to make sure we're as informed as possible before we make such a critical and important decision for not only for the state, but the people who are going to be participating in the program. So that being said, I guess we can move on to our next agenda item, which is the Executive Director's Report. An update on the Hawaii Retirement Savings Program budget.
So,
go ahead.
Sorry, an update on the budget will be provided at the January board meeting. I received the budget itself too late to provide it in your packets. Therefore, you can't review it or discuss it legally at this meeting. So we will discuss that in January. The 2026 Hawaii Retirement Savings Board meeting schedule. There are now 2 dates that you have to reconsider. So your January 20th meeting, we are either going to have to look at January 19th to hold the board meeting or the following Tuesday, the 27th of January. There is a scheduled budget briefing on the 20th.
with the Ways and Means Committee.
Yes. Your second meeting that you'll have to consider, and I will send emails out following this particular board meeting, is the originally scheduled for February 17th. That is a state holiday though. So alternative dates are Monday, February 16th or Tuesday, February 24th. Again, no decisions have to be made today. I'll send out meeting or emails to you and we'll go from there. Every other date is okay though. With regard to C, news from OIP, testimony for board subject to sunshine law. In this edition of news from OIP, the OIP addresses several questions from boards asking about various aspects of the sunshine law, including testimony requirements and how to manage testimony while still providing the public with the ability to attend and participate in meetings. So this is just as an FYI to board members. At the last board meeting, you set a time limit for 5 minutes of public testimony on each agenda item with the discretion by the chair to increase or decrease that time period. And then your next scheduled board meeting, again, I'll send out another date, so to be determined. That's it.
Okay, so our next agenda item is the next meeting, which, as you just heard, is going to be rescheduled from the tentative schedule Tuesday, January 20th, due to a Ways and Means informational briefing. And with that, go ahead and take a motion to adjourn the meeting.
Thank you.
All right.
Happy holidays.
Thank you,
everyone.
you too.
11:17.